Hey guys, how's it going? In this video, we're going to take a look at the basic overview and principles of retirement planning and investing. Maybe you just started your first corporate job, you've got a 401k, you've heard about IRAs, but you really just have no idea what you're doing. You're in the right place because I'm going to show you a really easy way to manage your assets so that hopefully one day you can retire rich. Just a little bit about me, why should you listen to me? My name's Grant. I'm the founder of the Easy Peasy YouTube channel. I'm not a professional investor, but I've been working as a petroleum engineer for about 10 years now, and I've studied the heck out of investing, and I just want to kind of give this information to you guys absolutely free. It's not going to be one of those videos where at the very end I ask you to sign up for some course or pay to hear the rest. It's just strictly free information. It's my gift to you, so please, enjoy this and retire rich is basically the idea. So I'm going to be showing you a method. It's called the 3-fund lazy portfolio. I've actually got a spreadsheet to go along with this. There'll be a link in the description so you can download this. It's a really simple sheet. All you have to do up here in yellow is you type in your age, or you select it from this list. Let's say you're 27 years old and your current savings, this is how much you've saved in your 401k, your IRA, and any kind of taxable brokerage account you may have. Your total retirement assets, you've got $50,000 saved, you're 27 years old. Basically what it does is there's some data here in these gray cells. It's going to look up kind of what the recommended bonds and stocks percentage is based on your age. It's using kind of a rule of thumb. It's referencing this chart too. So this is a nice handy chart. The x-axis, it shows what your age is, and the y-axis is your portfolio percentage. And you can see in the beginning, you should have 100% stocks, no bonds, and as you get older, reduce the amount of stocks. Also in this section here, it splits it up into what the percentage of US stocks should be in international stock, hence the 3-fund portfolio: bonds, US stocks, international stocks. So just a quick tutorial there for you. But really, before we get into the nitty-gritty details of retirement investing, I think it's important that we talk about this prioritization of savings. Maybe you've got a lot of debt or you don't have an emergency fund established, so should you just start investing in your 401k to the max? What's the priority here? So I'm just going to start writing some of this stuff out. So this is what I call the kind of prioritization of savings. I think you should be aware of this. Very important stuff. So the first thing you want to do is take full advantage of any kind of match that you're getting from your employer. It's basically free money regardless of your financial situation. If your employer is offering you, like a 6% match or something, I recommend go ahead and take the full advantage of that because, it's free money. I know, for example, my company, they match 6%, and it doesn't mean that you can only contribute 6%. It basically means that they will put in 6% so long as I at least put in 6%, and they'll match dollar per dollar. Some companies will only match 50 cents per dollar. So, if you have a company that matches you 6%, but it's only 50 cents per dollar, effectively they're only matching you 3%. So just something to be aware of. So after you've accepted the full match from your employer, the second thing you want to do is establish an emergency fund. Emergency fund. And in general, you want to have 3 to 6 months of living expenses saved, set aside in a high yield savings account. I recommend a bank called Ally Bank. I've been using them for years now. They've got very competitive interest rates on their savings accounts because they don't actually have branches. They don't have office locations that you can walk in, so they can reduce a lot of their overhead expenses and offer you those better rates. Highly recommend them. Also, if you've got an electronic bank like this, you're not tempted to spend the money. So it's really important to have this 3 to 6 month emergency fund because if you lose your job or you have some major vehicle expense or something, you can tap this. So once you've established that, the third thing you want to do is go ahead and focus on high interest debt. So pay off, high interest debt. So if you got some, big credit card bills or some student debt that, is really eating away at your savings, you want to go ahead and tackle that next. And then once you've knocked out all of your high interest debt, then you want to focus on maxing out your retirement accounts. So for the fourth step, I like to recommend maxing out your IRA first. Then after you max out your IRA, go ahead and max out the 401k. Then for the sixth item, then you can focus on your taxable brokerage account. And this is going to be like your E-Trade account, your TD Ameritrade, Scottrade, whatever it is, where you're just trading individual stocks, that sort of thing. So the focus of this video is going to be kind of on these 3 points in the priority list. And again, the reason I tell you should max out your IRA before your 401k is because in general, the IRA is going to have a better selection of mutual funds. They're going to have lower expense ratios, and they're generally cheaper to hold. If you're not aware, the IRS has rules on how much you can contribute to each of these accounts every year. So for the IRA in 2020, that's when I'm filming this video, you can contribute up to $6,000 per year. And for the 401k, I believe the IRS limit is $19,500, which that's just your contribution. It doesn't include the employer match. And then taxable brokerage, there's no limit on this account because it's a taxable account. Just in case you didn't know, the IRA and 401k, these are considered tax deferred investment vehicles. So basically what that means is you don't have to pay taxes on any of the earnings or growth until in the future whenever you go to withdraw the money. So that's, these are tax advantaged accounts. But in general, during this video, we're going to be talking about the portfolio. And a portfolio is not just your IRA or just your 401k. It's the combination of these 3 accounts. You've got an IRA, a 401k, and a taxable brokerage account. So, when you're kind of looking at, your overall portfolio, you kind of think about, I've got, this much money in my IRA, this much money in a 401k, and then here's my taxable account. And so we'll talk about kind of what the asset allocation or the percentage of stocks and bonds should be for your portfolio here. And so you just need to keep in mind, think about this sort of portfolio view on all of your accounts. And for me, I'm married, and so I have my IRA, my wife's IRA, my 401k, her 401k, my taxable account, her taxable account. So, it can be quite a bit to manage when you've got 5 or 6 accounts, across all those accounts. But, in general, if you determine I need 25% bonds, that should be the 25% bonds for the whole portfolio. So just wanted to let you know about that up front as we talk about this. And so now I want to get into kind of the basic concept of what is a mutual fund, what is a stock. I'm assuming that you know what a stock is. A stock is just an individual share. It's a piece, you basically own a piece of a company when you buy stock. And so the great thing about a mutual fund is that you kind of own, instead of just owning one company, you own a little bit of a bunch of companies. So imagine a mutual fund as kind of like a pie, and you split this pie up into thousands of little pieces. So I'm not going to split it up into thousands, but imagine this, these are literally thousands of pieces, and kind of each wedge in here represents a different company. So the great thing about a mutual fund is that you kind of diversify your risk by spreading it out across, a bunch of different companies. So if one of these companies actually fails, it's not going to reduce the value that much of the mutual fund because, you've kind of spread it out across thousands of companies. And that's the real advantage of a mutual fund, is that you can kind of spread that risk out. One thing that's really important when you're looking at mutual funds is to consider what is the expense ratio. Expense ratio. In general, it's recommended if it's possible for you to stay don't pick any mutual funds that have an expense ratio greater than 1%. So you want to try to stay less than 1% expense ratio, because this expense ratio is basically going to eat away all of your profits. And so I'm just going to show you something really quick here, just to make sure you're familiar with compounded calculations. The expense ratio has a compounded effect on your earnings over time. And so I'm just going to give you a really quick example of what that means. So if you're not familiar with how to do a compounded calculation, I'm going to show you a quick example here. So here's my example. So let's say right now you've got $50,000 and you think it's pretty reasonable. You can make, hey, I can make 8% per year in the stock market, and I want to know, after, let's say I hold this investment for 30 years and I earn 8% per year, how much is this stock going to be worth? And so I've got a calculator here to kind of help with this type of calculation. So let me go ahead and write the formula. So again, we've got $50,000, 8% per year is what we think we can earn over a 30-year period. So, this is going to be the equation: $50,000 times 1.08, and we'll raise that to the number of years that we're compounding, which is 30 years. So this would be kind of what the future value of this investment theoretically would be if we could actually earn 8% consistently every year for 30 years straight. So you type it in 50,000 times 1.08 raised to the 30th power, and this would be worth $503,000. That's quite a bit of money. $503,000. K is for thousand. Okay, so let's see what the effect of a 1% expense ratio would be. So in order to account for the 1% expense ratio, you just subtract 1% from the 8%. So that's kind of the best, easiest way to calculate that effect. So let's type in 50,000 again, and we'll multiply by now 1.07 raised to the 30th power. And so you'll see your final value is only 380,000. So 503,132 minus 380,612. You just lost $122,000 that you paid cumulatively over the life of the investment. So 1% expense ratio is not by any means a small chunk of change. And then there's something else I want to make sure you're aware of, and that is called inflation. Inflation can also really eat away from your returns. And in general, most investors will assume somewhere between 2 to 3%, 2 to 4% per year for the inflation assumption. So if we just pick the kind of middle point of 3%, I'll show you kind of what the effect of inflation is. If you're not familiar with inflation, the basic idea is every year they have an updated consumer price index value, and the concept is that as time goes on, the general price of goods and services tends to increase with time. And so it's kind of the idea that you could buy a house or you could buy some product 10, 20 years ago and it was much cheaper than it is now, and that's because of inflation. So basically the buying power of your dollar today is not going to be the same buying power in the future. So if you're planning for retirement, you want to make sure you understand the value of your dollar in the future. So if you kind of go back to this calculation and assume 3% is going to be eaten up by inflation, you can really kind of see what the effect of inflation will be on your final value. So if you go to 50,000 times 1.04, we're going to drop 3%. 1.04, we'll raise that to the 30th power. So now you're down to 162,000 from 380. So what this means, this is kind of what they call an inflation, adjusting your earnings for inflation. So if you put in $50,000 today, you earned 8% per year in the stock market, you paid 1% per year for the expense ratio, and you assume a 3% inflation rate, then this $162,000 would be a more realistic view on how much growth you had. So this $162,000 is kind of like in today's dollars because you're accounting for the growth. So, if something cost $162,000 today, you're kind of viewing it that, this $50,000 actually grew to this amount in terms of buying power. Even though the actual value is $380,000, you can only buy $160,000 worth of stuff, in today's reality. So it's just something to keep in mind when you're looking at, a long period of time for your retirement planning. So the next thing I want to talk about really quick is kind of what I was saying earlier. Let me just delete this layer. Go to the next layer. I want to talk about asset allocation. This was something I mentioned earlier. Asset allocation. Sometimes you'll also see online it's called AA. It's kind of something people talk about all the time. What is the ideal asset allocation? It's basically, what is the ideal percentage of bonds? What's the percentage of stocks that you need? These are basically different asset classes. These are places that you can store your money. You could have some money in cash. You could also look into annuities. There's a bunch of different asset classes. And then within the stocks, you've got a bunch of different, you've got kind of international stock. You've got US stock. And then within US, there's kind of three different buckets. There's large cap US, mid cap US, small cap US. And then for international stock, you've got developing markets, and you've got emerging markets. So you can get really detailed with stocks and bonds, and then you've got different types of bonds too, corporate bonds, treasury bonds. So it can get very confusing, which is why I like to stick to what they call the lazy 3-fund portfolio, which is really only comprised of 3 funds. So you've got, I'll just go ahead and write the funds that I use. They're Vanguard funds. And so you've got these are the ticker symbols for each of the funds. The funds, you could actually just Google search VTSAX. This is the total US stock market fund. So if I just open Google here, VTSAX, it's a mutual fund. It's actually an index fund, which we'll talk about in a minute. So you can see the value. It's not, I wouldn't really call it a share price. It's more like a unit price. It's not traded intraday. It has only one price value per day, and there's limits on how much you can trade these. You could also look into ETFs, exchange traded funds, which are more like stocks, but they're still mutual funds. You can trade them every day, but I like to look into index funds because the expense ratio is so low. But anyways, this is the VTSAX Vanguard Total Stock Market. And so the idea with this VTSAX Total Stock Market, US stock market, you're getting exposure to not just a large cap or a small cap. You're getting the proper exposure to the entire US stock market. So you don't have to worry about what percentage should be in each one of these buckets. You've got it all right here in a VTSAX Total Stock Market fund. And then for the VTIAX, this is going to be, so this was the US stock fund. This is your international stock fund. And so the VTIAX is going to cover your developing markets and your emerging markets. It's the total international stock market. And then finally, the last fund that I use for my portfolios, BBTLX. This is your total bond market fund. So it's going to cover everything you need: corporate bonds, treasury bonds, municipal bonds. Everything that you need in the bonds is going to be basically in this one fund. And what's great about these mutual funds they're basically index funds, they've got a really low expense ratio. In general, the expense ratio for all of these is below 0.1%, which is amazing. And so it's important to realize that sometimes, in your IRA, if you open an IRA with Vanguard, you will have access to all of these funds. Also, if you have a taxable account, like I said earlier, an E-Trade account, or you could even open a Vanguard brokerage account, you'll have access to these funds. But most likely your 401k probably won't have these, so you want to try to get as close as possible to, finding one U.S. stock fund that has a low expense ratio, one international fund that has a low expense ratio. You could try to divvy up all these different categories, but it just gets really complicated. And so, yeah, let me show you one other thing. Basically, if you had to remember one thing in terms of, making sure your allocations are correct, I highly recommend this simple rule of thumb formula. And basically what it says is that age minus 10 is going to equal your percentage of bonds. So for example, if you are 35 years old right now and you subtract 10, then that means you should have 25%, about 25% bonds. You don't have to follow this, perfectly, but it's just kind of an idea. So if you're 35 using this method, you should have around 25% bonds, which also means you should have about 75% stocks. And another good rule of thumb, of the 75% stocks, you want to have 70% occupied by U.S. funds and 30% in international funds. So this is just kind of a good kind of back of the envelope, just rule of thumb calculation. And in general, every year you want to rebalance your retirement portfolio, all of your accounts. You want to rebalance them to try to stay on this percentile, because every year you get a little bit older. So next year you'll be 36, and now you'll need 26% bonds and 74% stocks. So the idea is, as time goes on, you get older and older, you're closer to retirement, and the bonds are a more conservative investment. So you want to have more bonds as you get older because you can't tolerate the risk. This asset allocation is largely based on your tolerance to risk. When you're really young, you can basically hold 100% bonds, 100% stocks, because even if the stock market crashes, you lose all your money, nothing really happens until you sell, and you're not going to sell those stocks until you're older. So it's most likely that the stock market will rebound by the time you actually need the assets. So I've also got this spreadsheet like I was showing earlier in the video, where you just type in your age, how much you've saved, and it's going to kind of refer, there's a table here in gray, it's going to look up what the percentage should be. I don't actually use age minus 10 the whole time. I kind of use a variable one. In the beginning I start with age minus 20, and then I kind of work my way up to age minus 10. It's all preference. I would honestly say anywhere between age minus 0 to age minus 20 is kind of appropriate, depending on your tolerance for risk. So you just type in using this calculator, get the numbers there. The last thing I want to show you guys is a website that I use quite a bit. It's called Bogleheads. This is the getting started form. I highly recommend them. This is basically the philosophy I'm trying to give you a quick tutorial on. They've got all kind of great information here on the web. This is the getting started article, but if you just go to bogleheads.org, you can see there's a forum here, people asking questions, checking up on their asset allocations. Am I doing things correctly? I don't know what I'm doing. How do you rebalance? What are the tax implications? Is it better to put bonds in a taxable account or retirement account? So you can ask all kind of questions like that. And I also wanted to show you real quick, Jack Bogle, in case you didn't know who this guy was. This is Jack Bogle. He's the founder of Vanguard. He recently passed away last year, but he kind of invented these index funds, so we can thank him for helping us have an awesome retirement. So anyways, that's it for the introductory video. If you liked it, please comment, like, and subscribe. And if you have any questions, please feel free to leave a comment. Thanks. See you next time.